Have you ever noticed how a single economic number or one central banker's policy can shake the entire Forex market? Well, that's exactly what happened today. Traders are paying close attention to German inflation numbers and also comments from US Federal Reserve officials, also known as Fed speaks. Hello and welcome back to Today in Finance. In this video, we're going to explain why these two events matter so much, how it could impact the euro and the dollar, and what does it all mean for traders and investors around the world. So without further ado, let's get right into today's video. Germany has the biggest economy in Europe, so its inflation data is like a thermometer for the entire Eurozone. When German inflation rises, the European Central Bank feels the pressure to keep interest rates higher for longer, which technically supports the euro. But when inflation slows down, the ECB has more reasons to consider cutting rates, which usually weakens the euro. This is the main reason why traders watch German inflation so closely, as it gives a hint of euro's next move, especially against the US dollar. Markets expect inflation in Germany to ease slightly. If the numbers come in higher than expected, that could definitely push the euro up, as traders will think that the ECB will remain more cautious about rate cuts. On the other hand, if inflation is weaker, the euro may drop, as traders anticipate that the interest rates could get lowered sooner. In short, we can say that stronger inflation can lead to a stronger euro, and weaker inflation can lead to a weaker euro. And it's as simple as that. What Fed speak means. Fed speak is the term traders use for public comments made by US Federal Reserve officials. These speeches and interviews are closely followed because they give hints about future monetary policy. Since the FED controls US interest rates, even small clues in their wording can move global markets. Investors often dissect every phrase to understand whether the FED leans hawkish or dovish. Hawkish signals. When FED officials sound hawkish, it means they are worried about inflation and prefer keeping interest rates high. A hawkish stance typically strengthens the US dollar because higher rates attract global investors seeking better returns. For currency traders, hawkish comments are often a green light to favor the dollar over other currencies. Dovish signals. On the other hand, dovish comments suggest the FED is more relaxed about inflation and may consider lowering interest rates. Lower rates weaken the dollar because investors move money into currencies that offer higher returns. For Forex traders, dovish Fed speak is often seen as a chance to bet against the dollar. These signals can cause sudden dollar weakness and boost currencies like the euro or yen. Why it matters globally. Because the US dollar is the world's reserve currency, Fed speak doesn't just impact American markets. It impacts everyone. Global trade, commodity prices, and emerging markets often respond directly to FED commentary. This is why traders across the globe watch every word from the FED, no matter where they are based. The dollar's moves are simply too big to ignore. Today is especially important because German inflation and FED speeches are both happening closely together. This puts the euro-dollar pair, the most traded currency pair in the whole world, right in the spotlight. Think of it like a tug-of-war. On one side, the German inflation will pull the euro up or down, and on the other side, the FED comments will push the dollar in one direction or the other. And the outcome totally depends on which side's stronger. Higher German inflation and hawkish FED. If inflation in Germany comes in hot and the FED also sounds tough on rates, both currencies could find support. In this case, the euro might gain strength, but so would the dollar, which means euro-dollar may not move dramatically in one direction. Instead, traders might see choppy sideways actions with increased volatility. The bigger story here would be short-term swings rather than a clear breakout. Lower German inflation and hawkish FED. This combination would be very bearish for the euro. A weaker inflation reading would suggest the ECB could cut rates, while a hawkish FED would keep the dollar strong. Together, these signals could push euro-dollar sharply lower. Traders may view this as a signal to favor the dollar over the euro in short term. Higher German inflation and dovish FED. If inflation surprises on the upside and the FED takes a softer tone, the euro would get stronger while the dollar weakens. This could lead to a sharp jump in euro-dollar as both sides move in euro's favor. Traders may treat this as a clear bullish signal for the euro. The reaction in markets could be strong and swift. Lower German inflation and dovish FED. In this case, neither currency gets strong support. The euro would be pressured by weaker inflation, while the dollar would also be pressured by a dovish FED. Euro-dollar might move in a smaller range as traders wait for clearer signals. This scenario could drive more attention toward other assets like gold or safe haven currencies. For traders, it's a day to stay cautious but alert. German inflation and FED commentary can spark quick and sometimes unpredictable moves in the market, which means that the volatility will be very high. The key is to look at the bigger picture instead of just reacting to one number or one sentence. The Forex market is like a puzzle that's constantly changing. Today, two very important pieces are falling into place: the German inflation data and comments from US Federal Reserve. Together, they will help traders figure out where the euro-dollar pair is heading next. So whether you're trading short-term or investing for long-term, keeping an eye on events like these is very, very important. With that being said, this brings us to the end of this video. I hope you found this video helpful, and if you do, make sure to give it a big thumbs up and subscribe to my channel for more financial insights. I'll see you again very soon with another fun video. Until next time, take care.